And can we also note the action taken by me under delegated authority as set out in the agenda on pages 55 to 86. And that brings us to today's main item of business, which is a discussion on the Mayor's role in promoting financial inclusion. And firstly, can I ask members to agree the terms of reference of the discussion, which is to assess what the Mayor, the financial services sector and the charitable sector can do to support households in London to access affordable and appropriate financial services, as well as advice and support to enable people to ensure their own financial well-being and resilience. Can I now welcome our guests, and I'll actually invite you to each just introduce yourself, your name and where you're from. So would you like to start, Sharon?
Yeah. So I'm Professor Sharon Collard. I work at the Personal Finance Research Centre at the University of Bristol, and I'm also here as a member of the Financial Inclusion Commission, which was set up in 2014 to increase the profile of financial inclusion and to encourage government to look at financial inclusion as part of its wider agenda.
Marvellous, thank you. And Joan?
I'm Joan Driscoll from London Mutual Credit Union. I'm Senior Manager, and our credit union covers the London boroughs of Southwark, Lambeth, Westminster and Camden.
Thank you. Sian Williams is going through security at the moment, so she'll be with us very shortly. Laura, would you like to?
Yeah. Hi, I'm Laura Rodriguez from Step Change Debt Charity. We're a nationwide debt advice provider. We provide online and telephone debt advice.
Excellent, thank you very much. We were due to have Alan Nichols with us from the Lloyds Banking Group. He's unfortunately unable to attend due to personal reasons, but he will be providing the committee with written evidence in due course. Shall we get started? Yes. We're going to start by looking at the nature and extent of the problem of financial exclusion. And so what I'd like each of you to do to start off with is to just outline what is meant, in your view, by the terms financial inclusion and also the term financial exclusion. Should we start? Laura, would you like to?
Yeah, I guess we are sort of a debt advice charity, so we focus mainly on debt, but obviously there's a strong link between debt and financial exclusion, both debt being a sort of cause of financial exclusion and a consequence of financial exclusion. But I think generally we would just use the sort of accepted definition of financial exclusion being where people are unable to access the financial services that will enable them to sort of engage with society as it is today, to participate in society. So we would see it in those terms, but obviously our focus is primarily on the kind of problem debt aspect of that.
Thank you. Joan?
Well, for me, financial exclusion means not having access to affordable and ethical credit options, and also not having a choice. You know, I mean, that's what most people on benefits face, that they're very limited in where they can go. You know, if they want a new sofa or a washing machine, they can go to a pay weekly provider, but it's going to cost them £1,400. If they can have access to something like the credit union, they can get a loan for £400 and shop around and go to Currys just like anybody else. And having access to a bank account helps them in lots of other ways. You know, like don't have to have a key meter. You can pay your bills by direct debit. It's being able to have the choice, and I think that's people who are included have got choices, and the excluded haven't.
Thank you. And Sharon?
I think I was involved in some work with the Financial Conduct Authority last year that looked at financial exclusion and inclusion in a wider sense in terms of access to financial services, and I think the kind of framework that we came up with was kind of looking at the reasons why people experience problems, and they kind of fall into two camps, and that's consumers who aren't engaging with financial services firms at all, and that might be because they're not interested in the products that they offer, or they are interested but they can't access them for some reason, or they're worried about being refused. And the other group of customers or consumers are people who are engaging with firms, but they're either turned down, or, as Joan was saying, you know, they're offered a product but it's at a high price, or they're offered a product that doesn't have the features that they want. So we kind of looked at kind of unpicking the idea of financial exclusion to look at the reasons underpinning that, because I think that then takes you to different answers in terms of what the types of solutions might be. And in terms of turning it around and thinking about inclusion, it would be about addressing those issues so that people do have access to products that are reasonably priced, that they work well for people, and they're kind of provided respectfully and in a way that people can understand.
Thank you. Sian, can I welcome you to the meeting?
Thank you.
Everyone has just introduced themselves, said where they're from, and has also said what they mean by the terms financial inclusion and financial exclusion. If you've caught your breath, that would be fantastic if you could introduce yourself.
Thank you. I've been on a tour of the building. They sent me to an environment meeting first, so that was interesting. But I realised that no one was talking about the same thing. So I'm Sian Williams, and I am the Director of the Financial Health Exchange at a charity called Toynbee Hall in the East End of London. And Toynbee Hall is all about tackling inequality and poverty. My work there is thinking about these issues, so financial inclusion, financial education, financial health is our goal for everyone. So what do we talk about when we talk about financial inclusion? For us, really kind of financial exclusion, you've heard this in many different kind of phrases, but all around not having the access to the necessary financial products and services. But when we think about financial inclusion, we take it a bit further. So we're really thinking about impacts and outcomes. So we care enormously that having access to financial services and products leads to good outcomes around people being able to pursue opportunities, to live well and to live healthy, safe lives. So for us, when we think about financial inclusion, we think about both people's skills and ability to use financial products and services, but also that financial products and services and the organisations that use them in order to transact with us, so that might be a utility company, for example, are thinking about how people really behave and how they really think and their real needs, and then making sure that the financial services and products and methods of payment available to people work for them in their real situations. So financial inclusion isn't just about, can I have a bank account? It's, what does that bank account do for me?
Excellent, thank you very much indeed. My next question is really just about the extent of financial exclusion in the UK and in particular in London. I gather there are 200,000 people in London who do not have a bank account. Would anyone like to pick that one up? Shall I pick Sharon?
Okay. I don't have numbers at my hand, to my fingers, in terms of the extent of exclusion in London specifically. I would say the extent of financial exclusion, I think, is probably wider than many people think, because if we take bank accounts, for example, the type of identity requirements that are needed, many people don't have. So we know, for example, that 9.5 million people in England don't have a passport. There are many millions of people without a driving licence, and those are the things that people need to open a bank account. So, and there are other groups that perhaps we wouldn't automatically think of being at risk of financial exclusion, like people in the armed forces who move around a lot, and moving around a lot and having different addresses doesn't play very well with financial services. They can't really cope with that. So for example, if you wanted to apply for credit. So I think when we've been thinking about access to financial services, it's been in a broad sense of, you know, the wider issues. Traditionally, we have thought about it as being particularly people on low incomes. There's lots of evidence that people in social housing are particularly affected, and that still remains the case. And they are at the very sharp end of financial exclusion, I think. But it also affects many more people across quite a diverse range of situations. And for London in particular, I think there's probably issues around new migrants coming into London, people who are living fairly transitory lives, who will be struggling to perhaps engage with financial services because they require quite standard and kind of fairly traditional forms of identification and fairly kind of standard lifestyles to be able to interact with people. There are new types of providers, but I think we'll come on to talk about them later.
Laura, do you want to?
Yeah, just to add in that, so we've done some research looking at savings and also looking at access to affordable credit and affordable credit in general. And to talking about sort of financial exclusion nationwide, we sort of found there's a particular problem with savings, short-term saving levels. So around 14 million people from our polling didn't have enough to save for a rainy day, didn't have enough sort of spare money. And then in terms of kind of, we've looked particularly at the use of high-cost credit for essentials, and we found that sort of across the country over 1 million people are using high-cost credit like payday loans, home credit, pay weekly stores to pay for their essential goods and services. So in terms of mapping it across the country, those are some of the things we found. I think London-based, we did some work last year where we put out a particular report focused on London, where we looked particularly at problem debt in London, and we found that sort of around 500,000 people are over-indebted in London based on estimates from the Money Advice Service. So yeah.
A lot of Londoners.
Yes.
Yep. Yes, Sean.
So we work directly with Londoners, face to face, both delivering financial education and delivering both debt advice services and access to other information services. What we see both through our direct delivery and also through our research is, as well as everything that Sharon and Laura have said, we're particularly concerned about young people. So we see that young people who maybe come from a household where in the family circumstances they've not got their own financial products by the time they're from 16 to 18, then those young people tend to be very difficult to kind of include at a later stage. They're not building up the right documentation that particularly a bank or a credit lender, a mainstream credit lender, will accept. And so we're seeing, for example, where people are going to university and maybe they're living in and they don't need to pay bills, or if they've left school or college and they're sharing with other friends or they're sofa surfing, then again they normally haven't got their name on a bill of any kind. And then we see those people coming through in our research that if they're not included by the time they're 25, they've developed all kinds of other ways of coping. So, for example, they'll be using someone else's bank account to both receive and make payments. And once they're doing that, from an individual perspective, it's very hard to get them included because they're not building up a profile at all that a financial institution can look at and say, we know who this person is, so KYC, your customer, but also we kind of trust this person's credit or kind of financial skills to be able to trust them with our financial products. And then from a security perspective, that's very difficult because banks are trying to make sure that they know their customer to prevent money laundering and other crimes around finance. But actually we're kind of creating this pool of people who are using other people's financial products, normally legitimately, but it's difficult for them to prove that later. So in everything that everyone said, I think young people need to be on our agenda.
Got a major storm going on out there. Sounds like. Joan, would you like to add anything?
Basically all of the above, really.
Yes.
I haven't got figures for London, but I know of our membership, about 60% are people on benefits or on low incomes. And we're seeing more and more people applying for credit union accounts now because of the move to universal credit and the phasing out of the post office account. And they're the ones who are having problems trying to get bank accounts, basically, because, as you've said, they haven't got the history to, that you're going to straight away recognise them as a reputable member, customer. So we have to do a lot of work, and what Sharon said about the armed forces, we've just started, we're one of the 3 credit unions providing services for the armed forces because it's very, very difficult to even do an ID check on them because they are in barracks, they are moving around all the time. So we're working closely with the MOD on that one.
Can I just add also, it's quite difficult for people in the armed forces and professions like the police if they get into debt problems because there are restrictions, they're not you know, they could be kicked out of their job if it's found that they have debt problems. So I think there's some quite big issues about their ability to access advice, and I think, you know, there have been steps to try and help people in those situations, but that's quite a big issue as well, I think, for people in those situations.
Thank you. I've got one more question before I hand on to Fiona, which is just very briefly, is there anything in particular that you think has changed substantially over the last 20 years? In, you know, just in terms of, you know, are there things now that are adding to financial exclusion? Sian, you're nodding.
So housing, the way that housing works, the demand for housing, the squeeze on housing, everything I talked about just now about young people, but definitely housing causes problems for two reasons. One, because of the fact that people can't get their name on a property or their name on a bill because of shared housing or lack of access to housing, but also the way that the housing market requires upfront payments. So for people who are either having to pay fees and charges or having to put down a large deposit, you know, multiple months worth of deposit, we see people going to lenders to try and get that money because they're so desperate. Because if without somewhere to live, you can't work. It's really, it's a very, very difficult situation. So I think the housing change is important. The other one is absolutely the move away from face-to-face and high street presence for most banks, and particularly when we're thinking about when someone has got to make a big decision. So that might be getting your first account, your bank account, might be getting a loan, getting a mortgage, or having a conversation that you're struggling in some way. Those conversations are almost always best had face-to-face for the first time, or through telephone. But mostly people who are not very comfortable with financial services would feel more comfortable having the conversation face-to-face, and we're seeing the pull away from banking. And I think that, you know, you need to think about not just opening an account, but also using products and services. So, for example, the ATM machine network, you know, making sure that we maintain that well for people. A piece of research that we did for Link, the ATM scheme, showed that, you know, we tend to think of it as, you know, needing something within a kilometre where I can get money out, but actually London's profile means that a kilometre is a very long distance, and also, you know, that kilometre might be inhospitable for you and your circumstances. So I think just thinking about the built environment changing and being more and more about, you know, not built for people who walk, on people low incomes. And, you know, the fact that I saw 2 people kicked off a bus the other day because they didn't have an electronic form of payment. And you think about the move to digital, the move away from physical, the move away from cash, and the kind of the built environment and the housing environment, for me, all exacerbate these problems.
Thank you. Does anyone have anything else that's sort of significant that's changed over the last 20 years?
I can sort of add to that, just briefly looking at sort of our clients. 20 years is obviously quite a long time, but I think more in the sort of the last few years, but we've seen a massive increase. Well, there's been a massive increase in private renting, and that has borne out in our clients. So it used to be sort of half had a mortgage, half of our clients nationwide had a mortgage, and half were renting. Whereas now it's sort of 70% are renters, and it kind of links to that younger population as well. We're sort of seeing a growing number of younger people coming to us with debt problems. And the other thing I had, the sort of across debt advice is that we're seeing a lot more people in essential bill arrears, or essential what we call priority debt arrears, so council tax, energy bills. Those are some of the issues that we're seeing, as opposed to, it's not that sort of unsecured credit has gone away, unsecured debts, sort of credit cards, overdrafts have gone away, but there's been this increase in people who are really, really struggling to afford to pay their council tax or to pay their energy bills. So those have been some of the changes in the last few years.
Just to add to what Sian and Laura have said, I think the other big change has been around, in financial services, the move to automated processes. So, you know, very much driven by algorithms, very much driven by the move away from kind of manual face-to-face processes to much more kind of automated processes, which, you know, serve some people well and they serve other people really badly. And, you know, as we talked about, as Sian's talked about, you know, if you've got a thin credit file or there's not much information about you, you know, the automatic process will probably spit you out because it can't doesn't have enough material on you. And the other kind of link to that is the idea that having more data on people and having automated processes means that you have much more segmentation in markets, so in the insurance market or in all markets actually. And again, that serves some people really well because they, you know, they're taken out of a risk pool and they're treated better. But for people who perhaps would have benefited from being in a bigger risk pool in the past, they may be excluded altogether or find it much more expensive to access products and services.
Jones?
Really, this sort of covers all of it because we all see the same
Yeah,
things that are being presented all the time.
thank you. Fiona, can I pass to you to look at access?
Yes, I want to, before I go on to the sort of suggested questions, it's just a point about what's changed as well around bank accounts. Because the figures we've been given, it looks like there's still a significant number of people who don't have a bank account now, but it's far less than it was 15 years ago. Does that mean it's harder for those people who don't have a bank account now than it would have been when there were, I think the figure we've got for UK figure in 2002-2003 is 4.4 million. Does that make it harder for those people who are in the group that don't now? And thinks and nods.
I think so. I mean, when we did research going back to the 1990s on this subject, when the number of unbanked people was bigger, but still a minority, what we were saying was that, you know, it is a small proportion of people, but the impacts on them are disproportionately large because of who they are and what it means for them and what they can and can't do because of that. But also I think it picks up on Sian's point that you've got this shadow banking going on where people have access to banking because they're using somebody else's bank account, and we wouldn't ever see those people. We don't see those people in the statistics at the moment. So I think it does become more difficult for them, and they're using workarounds which perhaps put them in states of vulnerability.
And do we know how many people are using that sort of workaround, using other people's bank accounts? Got no figures for that.
The numbers are hard, but I think from our research, I would say you see it most in the younger generation because they're in a digital world, and to do most things, they need to be able to pay online, and so they're asking someone to pay for them. Whereas someone who's much older, say 45 and above, they've probably got established payment methods in cash or prepaid cards, kind of prepay meters, those kinds of things. Probably their life is quite small as well. So what I mean by that is, a piece of research we did for Link, we talked about kind of circles of economic activity. So if your life takes you a long distance, then you kind of need more payment methods. Whereas if your kind of footprint of your life is quite small, you know, it's this set of shops over here that you can go to by bus, and maybe you're on a pension or kind of benefits of some kind, and you don't really need to kind of go to a place of work. You don't need to buy many things regularly other than food and essentials. You can probably get away with paying mostly in cash, particularly if you're using a pocket. So I think it's about a kind of an age divide there as well.
Yeah.
The question about does it hit people harder now to not have a bank account, again, I think it's still about younger people mostly are hit the hardest, because they will really struggle to get a job without a bank account, and they're caught in a kind of catch-22 without documents to get a bank account. They might not get the job offer, and I've worked directly with people who've had a job offer withdrawn because they couldn't produce a bank account to be paid, and either they felt too embarrassed to say that they didn't have a bank account because they thought it implied something about them, or they've been told, well, we can't pay you because this is how we pay. We don't have any other mechanism. So that move to everything being digital, everything being automated, everything being through a bank account makes it very, very hard for someone to do anything other than cash in hand work.
So do we have figures for the age profile of the 200,000 people without bank accounts in London? Do we know what the age profile is, or is that sort of beyond the scope of the figures?
I would imagine the figures do exist. I don't think they've been analysed. You would get the information from the Family Resources Survey, which collects that information. My guess would be that it wouldn't have changed very much over 20 years, so it will be young people and older people, and older I mean kind of probably 70 plus, and young people kind of 25 and under would be where the pockets of unbanked people are.
Okay, thank you. And some of the barriers to people opening bank accounts have already been mentioned. So the sort of lack of papers, lack of bills, lack of passport, lack of driving license. What other barriers might there be to someone opening a bank account, and how can all the barriers be removed, or can they be removed?
From our point of view, we have the banks in Peckham, where our head office is. They keep our leaflets in and they send people up to us, because quite often we can open an account for them that they can't. Although they're going to provide the basic bank accounts, they still want the photo ID and various other things. To become a member of the credit union, we will accept a letter from the DWP as a proof of ID, if it's got your national insurance on it and things like that. We also do online checks, because we've got the same know your customer criteria as anybody else, but that entry, we will accept less things. So we're trying to get over that. And, you know, I know that you're saying that a lot of people use other people's banks, but that's becoming more and more difficult, because, you know, if we're going to transfer, we've got a new thing now, if we're transferring a loan to somebody's bank, there's something called a bank wizard, and it actually checks that, you know, it's Sian's bank account and it's Laura's, you know, so it actually checks the names, and so technology is becoming so that people are going to have more problems.
Yeah, I mean, one of the issues potentially, obviously, you mentioned that even with that you'll accept a letter from the DWP, but the banks won't. That's even the case for the so-called jam jar accounts then, which are relatively low risk for banks?
Yeah, but for our jam jar account?
No, for all banks seem to have jam jar accounts now, which is sort of presumably designed for people that they don't want to give credit to. But
So basic bank accounts
yeah.
Are not the same as jam jar accounts. So jam jar account has sections within it that you can allocate specific money to specific purposes.
Yeah.
But in this context, it's a basic bank account which has no credit attached to it.
Account.
Yeah.
So that's the agreement from January last year with the Treasury and the main 8 high street bank providers, that they would each offer a basic bank account. They had been before, but over time, the kind of features on those accounts and the terms and conditions of those accounts had all diverged. And it was very difficult to see which bank was actually offering properly. So we had the agreement with the Treasury, which we, Toynbee Hall Systems Advice, worked on to achieve that agreement. Now all high street banks provide a basic bank account, no credit, and also they accept, or they should accept, and this is one of the big issues about policy practice gaps. So what is the policy, but what actually happens in practice diverge enormously, and we're working hard on that. So they should accept lower forms of ID. So, for example, a letter from DWP, a national insurance letter, and a letter from DWP can say you're not entitled to benefits, but we know who you are, because it's a form of government ID. So they shouldn't have to, so an individual shouldn't have to produce photo ID for those accounts as long as they have ID and an address. However, banks find it really difficult to work kind of consistently with that, to train staff to understand what to accept. There's a huge amount of nervousness because the FCA fining banks for allowing accounts to be opened fraudulently means that when you're presenting different forms of ID that are not a kind of a passport, for example, banks are very nervous, staff are very nervous because they know that they'll individually suffer. Maybe they'll lose a bonus if they're the person that's putting through accounts through other forms of ID, and those accounts are then closed later by a security department. So we're working with UK Finance on how we can get standard forms of ID and also how we can train staff in banks to feel more comfortable and confident they're doing the right thing. So that is a key barrier, that even when people have ID that the banks formally accept, frontline staff don't accept it, or security departments later reject it.
The other thing that kind of sits behind it is that basic bank accounts don't make any money for banks. They're not exactly a product they want to flog. So I think that's part of the problem as well.
Yeah, we see, so in the debt advice process, people will be often be sort of signposted to say open a new fee-free basic bank account with a separate bank, but in order to sort of separate their transactional banking from their debt, so their overdraft debt or their personal loan debt with the bank, with another bank. So we'll suggest that to people, but what we're finding is we are still seeing cases where people are going to a bank, or they're going to 3 different banks in their town, or if they're open, obviously, but and being refused for various reasons. Some are being told to go back to their original bank. Some are being told, we just can't accept you, not really given a reason. And yeah, we are still seeing those cases, which we were sort of hoping with the new basic bank account that things would be a little bit more improved there. So yeah, I think it is a case of still of possibly the Treasury or pressure being put on the banks, or speaking through, working with UK Finance, as Sian says, to say, well, it's also a kind of a debt advice problem, because one of the things we're saying is that if banks actually just did it themselves, rather than meaning that they had to go to a different bank, they just separated those two things out, so they could have a free basic bank account that is guaranteed to be separate from their existing debts, then that's something that we want to talk to, we're going to speak to UK Finance about, and one of the issues that we raise, because it causes a problem for our clients through the debt advice process as well. So yeah, it's definitely one of the main barriers.
That is actually one of the policy agreements. So if that's happening, then we have a very strong case to collate those figures about specific banks and going back to UK Finance and the Treasury, and they will sort it out.
Yeah.
So we'll work on that
Yeah.
one.
The campaign is born.
Yes, because
Thank you.
the right is that if you're in financial difficulty, you have a right to a free basic bank account with no right of offset by the bank, i.e. they can't take your money for any debts to them.
Okay, thank you. And the bank branch closures, as we mentioned before, but it'd be helpful if panel members could comment on what impact bank branch closures have had on people's ability to access financial services. Is there anything else to add?
For me, none. I can't remember the last time I went in my bank, and I bet none of you can. If people are digitally empowered, then they can, but as you're going to discuss later, not everybody is. For the majority of people, very little. It's probably opened it up in some ways, but for a lot of people, they're excluded. Again, you're coming back to the exclusion.
So the impact that we see is less in London, to be fair, but that's because even in London, with the bus fare, you can normally get to a branch. But the issues that we see are for young people who are in this position of having different ID documents. They will be told to take them into a branch, and that means that they're already kind of struggling with inclusion, and now they've got to go and find a branch where someone will talk to them. And when we see that happening, as Laura's mentioned, we'll see the same person go to maybe 5 or 6 different banks in a day, over a couple of days, and be turned away again and again and again. And so if they had to travel a long distance to get to those branches in the first place, it's just another psychological and physical barrier to going back to follow up. So we see that as a problem. But also, if you think about people with issues around travelling, so that might be someone with a mobility issue. One of the people that we interviewed for one of our research pieces talked about when it was good weather and she was on her mobility scooter, she could go to the ATM and the bank that was further away because things had closed and it was okay. But when the weather was terrible, it was really going to be a kind of impossible journey. And the second thing there is around, if we think about profiles, so age-wise, older people will traditionally be more comfortable going into the bank to have a conversation about something, particularly big decisions. So if they need to transfer money, if they need to, if they're moving from working age financial situation to pension age situation, whether that's benefits or pensions, all of those things, they'll probably want to go and talk to someone. And doing that over the phone, particularly if they've got hearing issues, even if it's not formal hearing loss, just kind of having to struggle with a call centre, all of these things we know make it harder for people to get the information that they need and to transact in the way that they need to.
Thank you. I've got a couple of questions now on savings in insurance, and then I'll hand over to Andrew to cover other areas. I'd like to ask what the financial sector should do to support more low-income households to save and to access insurance.
Shall I go?
Yeah.
So savings, is an area that we've looked at in quite a lot of detail and done some research on. We've looked at sort of other countries where there's slightly different systems available for saving, and I think what we found was there's a particular issue around kind of low-income savers, because what incentive is, if they're struggling to save anyway, kind of what incentive is there to make it easy for them to save? And I think there is very little, and then couple that with kind of consumer behaviour, inertia, and those kind of things, and that's why you have the sort of 14 million people who aren't saving. Not that all of them are low income, but I'd probably say a sizable amount of them probably are. I think what we've said is we've looked at some other schemes. There's things like prize-linked savings schemes that have appealed to low-income savers in other countries that have made a difference. So I think that was one of the things we saw. And another one was, some things around some of the stuff we've talked about with digital nudges and that kind of thing to make people aware of where they could possibly be saving. I know that some banks are looking into it, but there's things about, so say you spend $3.99 or something, it's sort of 99, you save that 1p, or those kind of things. But I think it's a question of whether people will be incentivised by that. But I think the key sort of principles are to make it easy for people, make it understandable for people, and give them an incentive to want to save and to realise the benefits of that. Because I think for some people they just think, well, I have very little to save anyway, if anything, and why would I do this? It's not really going to help me out in the longer term. So it is quite a challenge, but I think there is more that banks and financial services could be doing.
And does the cost of living in London make it harder for people to save? Are the high levels of people without savings in London than elsewhere in the country?
I think we haven't done it. I don't think we looked at that specifically, but I would assume that if there's a crossover between, like say, that sort of younger population, that higher renting costs particularly, higher cost travelling costs in London, that kind of thing I imagine would exacerbate those other reasons that I sort of talked about around inertia and having very little left over to save.
And what role would the government have to support more low-income households to save?
Let us work. But we've done some work on. So they've introduced they're introducing the Help to Save scheme, which we've been involved in and we're supportive of. But I think broader than that, what we've looked at is ways that to kind of make it more automatic to save. That those have kind of improved in the sort of pension sphere of a way to help people to save. So one of the things we've talked about is within auto-enrolment having a kind of accessible pot of short-term savings so that people can access, the £200 or £500 they need to fix their cooker or whatever, rather than turning to high-cost credit or lending to help them there. So I think that's one of the things that we've been talking to the government about.
Okay, and insurance, because that was the second part of the question. Are there specific ways that the financial sector and government can help people or support people or encourage people to take out insurance?
Can I come in on the savings piece and
Yes,
link them
of course,
together? So a piece of research that we did last year, this year maybe, I lose track of time, looked at the fact that actually many more people are saving in some informal way than the figures would suggest. And so I think that's the kind of the key thing that we need to start doing is designing products and services that meet the way people really behave rather than what the data suggests. So, for example, breaking it down into making savings, saving as a kind of thing in itself, and then having savings, and they're three different things. So making savings is something that we as a culture naturally enjoy doing. We kind of talk a lot in our culture about, I got this bargain, look at eBay, look at all the ways that people kind of think about making savings. And we don't tap into that. Financial services don't really tap into that particularly well. That's a huge motivator for many, many people. If I can get the same thing for less money, that frees up money that I can then put to one side without feeling that I've had to sacrifice. Because when we talk to particularly low-income people about saving, what they hear is I have to go without. And so that trips people into thinking, I can't save, I don't have enough money. In our financial education programme, Community Money Mentors, which works primarily with low-income households, we saw that people spontaneously started to save once we showed them how to make more savings. Because they weren't being tripped into thinking about deprivation, they were happy that they'd got spare money, but they'd got the same quality of life as they had before, and now they could put that money to one side. What we then saw was that they had nowhere suitable to put it, so they were still keeping it at home. And one money mentor describes brilliantly how she went into a bank to say, I've now started to save, can you give me a savings account? And the person behind the bank counter started talking about ISAs and thousands of pounds a year, and that person was saving a few pounds a week with pride. After that conversation, she left in shame, thinking that her savings weren't savings at all. And so one of the recommendations that we've made in our report is really understanding that we've got to start talking about saving in a way that is real and real for people. So the other thing there is about the idea of building up savings. So we make that the goal, but actually for most people in London, unless they're in kind of a very good financial position, what they really need is some money that they can dip into when crisis hits or an unexpected cost hits them. So we don't really want them to build up savings permanently. We want them to have a buffer that they can then spend down and then regain. And so we want to kind of get financial services thinking about that. So rather than saying, you have to have this balance to be able to benefit, what we want them to start thinking about is what actually if you had savings going up and down in rhythm with people's real lives. And we want to link that with pensions. So we hear a lot of people talking about, I can't afford to save now, let alone a pension. So there's a concept being talked about in the States at the Aspen Institute, and they've brought the concept to the UK, and Nest are kind of talking about this, which is around what if we had sidecar savings linked to pensions. So you could, for example, build up, you'd say, like, my emergency buffer is £300. So I'll save until I've got £300. Once I've got £300 saved, every pound of saving would then go into a pension pot. If I needed to spend down that £300, so I need £150 of it, then my savings now go back into topping that up to my contingency, and I stop saving into a pension. So the idea that you're always saving for a pension in the future when you've actually got needs now puts people off. But we want to kind of get financial services thinking in these more flexible ways, and that links to then insurance, because actually sometimes insurance is a worse option for a low-income household, because when they've paid that policy premium, they'll never get it back. Whereas if they were linking that into a product that was savings, and they knew that there were 2 or 3 key items that they really needed to have covered, just the bare essentials that would get them up and running again, then actually that might be a better use of savings, putting that there. So thinking about combining different products rather than having savings as a standalone, pensions as a standalone, insurance as a standalone, looking at a household's composition, what their needs are, and then thinking about what a blended set of products might do, because then that allows people to think about their whole asset base, income, outcome. What does that look like? What would that look like for me as a family, as a household? Where are my needs and how can I meet those best? And so we think that the kind of split of financial products and services into these, kind of silo thinking prevent people using products that they could actually use if they were blended.
Okay, thank you.
Can I just come in on the insurance point, because I think it has always been, and we're talking particularly about home insurance, home contents insurance, it's always been a bit of a Cinderella area for financial inclusion, I think, but I think it is a really important part of the kind of protection and savings landscape that gets kind of overlooked. So we know that, of 10 million UK renters, about 5.6 million of them don't have basic home contents insurance. And I don't think it's lack of product, because there has been quite a lot of effort from the financial services industry to develop low cost, reasonable coverage plans that kind of fit in, that are probably 70, 80 pence a day for people, but the take-up just isn't there. People aren't, it goes back to my thing about people engaging and people not engaging. People aren't engaging with those products because, as Sean was saying, they don't see the value of them. And, short time horizons, means they think that those things aren't ever going to happen. But it is something the Financial Inclusion Commission is concerned about, and off the back of some work that Scope was doing around access to insurance, the Commission is now looking at access to home contents insurance. They've put out a call for evidence. They're planning to collect some data and look at ways which kind of tap into some of the things we've already talked about. So, you know, automatic enrolment ideas, but also where does government come in? Well, government, you know, has created flood re for homes that don't have access to home contents insurance in high flood risk areas. So are there some of those ideas that are around that actually could apply to a wider group of people and kind of make sure that they have got appropriate savings and protection when things go wrong?
Thank you.
Yeah, I want to talk about credit. Before that, a couple of questions just following from what Fiona said. On the insurance thing, it's part of the issue really there that people who are in the low income challenged area, actually the value of their contents is so low that it really isn't worthwhile
Yeah,
getting a policy.
absolutely.
You
I
probably
think
talk
that
about a
would be
TV
true.
and a hi-fi or something like that, and that's about it.
Well, yes, but also beds and sofas
Yeah,
and
of course.
carpets. Yeah,
Yeah,
they don't
well-
think like that, you're right.
Yeah, well, there are two different things. One is, you know, the risk of fire, like we saw at Grenfell, and a lot of those people weren't
Yeah.
insured at all, and they're in a real mess, or the risk of being broken into.
Yeah.
And we know that less well-off people are more likely to be burgled than wealthy people. What have they got worth nicking beyond the TV and,
Yeah.
Yeah.
and
I think
probably not
people
much
make
else?
quite rational trade-offs and say,
Exactly,
well, I'm on the
yeah.
third floor, the chances of me being robbed are not very high, the chances of something going wrong don't seem to be very high, so why would I? It just
Yeah.
doesn't feel like a very attractive product.
Mm.
And I think you're right, there's probably a group of people who it doesn't make much sense for, but if something did go wrong and their landlord kind of expected them to cover things that had happened, then that I think it's one of those things where the probability of things happening is low, but the risk of the impact is really high. So it's kind of balancing those two things.
Well, again, it's looking at different things. There's theft, and then there's fire and flood.
Yeah,
You know, and you know, maybe with what's happening in Grenfell, people might think differently. Bearing in mind the news we've had today, that only 2% of tower blocks are full fire precautions. Going on to the other points that Sean was making about saving, one thing that sort of comes through, but I suspect probably doesn't apply here, is the disparity between interest rates for savers and inflation. Presumably, we're talking about such relatively small amounts. That's not a feature that actually figures with anybody.
No, I think when you are on a very tight or low income, you're not thinking about interest rates at all. It's a whole different kind of mental process. It's more, I need to save for this, well, I want to buy this thing or I need to pay for this thing, but I can't pay it in a lump sum, so I'm saving towards it. And therefore the kind of interest rate inflation equation is a whole different kind of sector. And that's why I think that, you know, the savings industry talks a lot about it's not enough, you know, kind of economics are not in our favour to get people to save because of that precise issue. But then they're not understanding all the other motivators and all of the other factors that you can trigger someone into thinking about saving, about behavioural economics. They're just not using them.
Okay.
Can I just, make the other point that what we need to be really careful about is that when people do save, they are protected, because what we had in the past was, you know, Christmas hamper schemes that went bust and people lost all their money. So if there are new forms of saving that aren't regulated, then those need to be brought to the regulator's attention, because they are putting people's small amounts of assets at risk. So we need to be really mindful of those situations, I think.
It brings me on to what I was going to ask you about, which is really, first of all, the regulation of credit, and the government has acted in relation to this. So there's two questions here that rise for me from that. And the first question is, has that had an impact on driving out loan sharks and what is effectively illegal lending, or is that still going on, and if so, to the same extent? And the second question is how effective the government intervention has been on, inverted commas, legitimate payday loans, and what sort of APRs they're now charging.
Can I just say from our point of view...
I want to come on to credit unions later as well.
Yeah, it's very hard to find out about the loan shark issues because people, for obvious reasons, don't want to talk about it. But we hear anecdotal things, and I don't think that problem's gone away at all. And I don't think that what's happened around payday loans has made a huge amount of difference. You know, I mean, I think Wonga is still 1,500% or something like that. So some things are helping, but it really hasn't made much difference as far as we can see in our sector.
I think government intervention is in terms of the price cap on payday loans, but then there was also the FCA regulation around it, and I think together they have made a big difference to the payday loan market. You know, we saw a sort of 30% drop in clients come to us with payday loan problems, whereas from 2013 to sort of 2016, whereas in the few years before 2013 it was just kind of extraordinary rise in people coming to us with payday loan problems. So I think it has made a big difference there. I think in terms of the market itself, it has shifted, but I think the FCA has done. They recently reviewed the price cap, and they did find some, you know, that fewer people are taking out payday loans, and then also fewer people are getting.
Well, that begs the question: why are people taking out fewer payday loans if, given the continual economic pressures caused through a variety of things, the cost of living that Fiona mentioned, the instability of people's incomes because of the way that social security is now worked out, zero-hours contracts and all that sort of thing.
Yeah.
Why are people taking out fewer payday loans? Is it because they can't access them, so we're going back to the loan sharks? Is it because the enforcement isn't there?
I think if you look broadly at the kind of the growth of payday loans and the people I think that took out payday loans between sort of say 2008, 2009 and 2010 to 2015, 2014, 15, where the changes in the regulation and the price cap came in. I think there'll be an element of those people that sort of, when it was sort of brewing up Wonga, and it was like, oh, this new thing that, oh, I can just get. There was an element of sort of marketing creating the demand, so I'd say there's probably an element of people there who now have realised didn't really need it, but thought it was sort of just needed it at that time. I think the question about where people have gone, it was a thing that the FCA was very interested in, and something that we looked at, kind of where people have gone, where they're rejected or when they can no longer get payday loans. I think it's not as simple as kind of they don't get payday loans, so they go directly to their loan shark, because a kind of a community loan shark, because the people that took out payday loans were generally sort of younger people who were employed. They were on a low income, but not in the really deprived. You know, they were working. They weren't in the really deprived communities, which are more linked with kind of community loan sharks. So I think there was a slight kind of conflation of a problem that. Obviously, loan sharks are a problem, and they've remained a problem, but it was quite a different sort of population, I think. And I think in terms of where people are going, we looked at it, but there's various things that if you put yourself in that position and you say, okay, well, I needed that £200, I'd heard of a payday loan, so I'll go for a payday loan. I think when we looked at it, we asked our clients, we didn't get a huge sample, but we asked them sort of what they did, and it's a range of things. You know, some people would just go without, some people would borrow from family and friends, and we have seen an increase in people borrowing from family and friends. Some people, if they could go to their overdraft or their credit card. But yeah, so I think it wasn't as simple. Yeah, it was kind of, there's various strategies that people use. And I suppose it puts pressure on looking at the regulation of credit cards, overdrafts, of other high-cost credit options, and making sure that people aren't getting into difficulties there. So, yeah.
And just jumping in on that point that although the numbers of people taking out payday loans have dropped, and that's partly, I think Laura makes a really good point, that I think a lot of the kind of bubble in payday loans was created by the marketing of them, and some fairly pernicious practices around texting, online marketing of those products. But it's also, what we have seen is the numbers of complaints to the Financial Ombudsman Service keeps going up, and that's around checking affordability. So, you know, there is still, the Financial Conduct Authority has been addressing those issues, and I guess we're seeing a bit of a lag in terms of affordability issues, but those issues are still there. And I think Laura's point is a good one about, you know, there is some overlap between users of payday loans and users of loan sharks, but I think it's fairly small. The other thing that the FCA's research did show was that they identified about 40 online lenders which weren't authorised with them. So that's something that we haven't seen before, where loan sharks have mainly been operating in fairly small communities, but there is some evidence of illegal lending online. So I think that's a new facet of it.
I think, you know, the payday debate was an interesting one because it was, to a certain extent, on both the provision of payday loans, but also the attempts to kind of rein it in, was driven by media and kind of people's use of the media. And I think that because it was an easy subject to attack, you know, you never looked bad if you were saying that payday is, you know, kind of the equivalent to loan sharking. It meant that other issues were not being addressed. So unauthorised overdraft fees, minimum payments on credit cards, and the damage that does to someone's finances long term. You know, those rates are considerably higher than payday in real terms, and the scale of them is considerably higher in real terms. But also the rent-to-buy sector, you know, bright houses of this world. We know that those are causing significant problems for people. And so, you know, the FCA is just starting to look at those issues, and we're seeing some preemptive movement by banks to change their overdraft fees and various issues. So I think on access to credit, when we call it high cost rather than payday, we're still a long way to go before we've got that market right. You know, credit union is capped, but no one else other than a short-term high-cost lender is capped. It seems strange that these are the two forms of credit that are capped, but nothing else. So we've got a lot of work to do.
Maybe on the next question about regulation of other forms of short-term or high-interest credit, and I think you probably answered that question saying it should be done. But regulation is one thing, and enforcement is another. How well are these, as the existing regulations that are supposed to control excesses of payday loans, or whatever you want to call them, how well are they enforced? Or is it just one of those regulations that is sort of paid lip service to? Because there's not much point in further regulation if the existing regulations aren't properly enforced in the first place.
I think the evidence from the review shows that the cap is working. And actually it seems to be working. They've actually got more lenders in the market than they anticipated. The FCA's got more lenders in the market than they anticipated. So I would say in that respect it seemed to be working, and it has certainly achieved the aims that it was set out to achieve, and the other evidence would have told us was what was going to happen. But I think there is other work to be done. So on the affordability point, the FCA has just put out a consultation on how firms assess creditworthiness and affordability across the piece, not just, you know, subprime lenders, but, you know, credit card companies, banks and whoever. And I think that is another really important piece of the jigsaw, because what we want to be doing is making sure that lending is affordable for everybody much further upstream to prevent problems happening downstream.
So that trend is going in the right direction, but too slowly, or not?
Well, I think there
are
are gaps, as Sean was saying. There's areas that the FCA is just starting to look at, which perhaps to be fair, I mean, it only started regulating consumer credit in 2014, so it's a pretty big and diverse market.
Affordability is a very difficult thing to kind of get right, but we've tended always to see affordability applied in this way: can you repay me? Not what will it do to you to repay me? And so affordability is a bit of a kind of a strange word. And I think, you know, it's incredible. You know, we see it from credit unions to high-cost lenders. The minute you start to really scrutinise the person's finances, they become less willing to share because they're nervous. You know, the credit scoring, credit footprints, credit as a kind of a source of livelihoods in so many different ways. You know, can I pay the electricity bill? Can I pay the mortgage? You know, the range is huge that people use credit for, and it's not just buying a TV. People get really scared. You know, so credit is one of the areas where it's a very kind of strong power balance in the lender's favour and in the regulator's favour, and the individual often feels unfairly scrutinised or uncomfortably scrutinised, even when you're trying to have a good conversation to kind of get good outcomes. So it's a tough area, but we would like to see affordability seen in that way of what will it do to you to repay me? Is this kind of package going to work for you long term, rather, you know, on your long term financial health, rather than just can you meet these weekly or monthly payments? And in terms of you know, kind of, have we seen the regulation do bad things? No, I think it's a very tough market.
I'm not saying that regulation's done bad things. What I'm saying is, are they properly enforced? That was the question.
Yeah, so I'm going back to the question about, is it forcing people to loan sharks? I don't think we can say that the FCA's evidence is wrong. We've got no other data to suggest that people are being forced in that direction. And are they enforcing? Yes, to the best of their ability, but now that digital lending is so easy, as Sharon said, you know, firms can just pop up on the internet. It's very, very hard.
Can I just come in on that point about enforcement? Because I think the other thing is that, you know, I think the UK is probably unique in having illegal money lending teams that operate across the UK, and they are doing a fantastic job, and they have been doing it for quite some time, and they need the funding to do it properly, because it's, I think, if the payday cap has shown anything, it shows that illegal money lending happens in communities. It's a constant, really, and possibly increasing. So, you know, in terms of enforcement, those teams need to have the money to enforce against those illegal lenders who cause such financial and other detriment, and they're quite difficult cases to enforce. So I think that's you know, there is the FCA, and there's also the teams that are doing that really important work in very deprived communities.
On that particular point in particular, I mean, presumably the legal ones have to pay a licence fee to be allowed to do it. Is that licence fee pitched at a level that supports the enforcement action against the illegals? Because presumably it's in the interest of the legals to drive out the illegals, which is what we've seen, for example, on claims companies. Their fees that they have to pay to the Ministry of Justice are much higher to provide the money for enforcement against the ones who are doing it in an unlicensed illegal way.
There has been a discussion about how the illegal money lending teams get funded, and I think you would need to check, but I think I'm fairly sure in saying that absolutely, actually the lenders and the subprime lenders in particular were happy to pay towards their funding, and I think that is now in place. I will look to others too. It was through the Treasury, so there was an agreement reached last year which put them on a more secure footing.
Can I just quickly add to what Sean was saying about unarranged overdrafts in the affordability space? It was quite shocking to me, I think, when the FCA, and in terms of the idea of regulation across consumer credit and not just payday loans, and sort of looking at those other types of credit, I think with unarranged overdrafts that the FCA found that the banks don't even have to do an affordability check to give someone an unarranged overdraft. And some work the Competition and Market Authority looked at, and they found overdraft use, and they found that over half of the people that went into an unarranged overdraft didn't actually know that they went into it. So I think there's definitely, you know, payday loan regulation, I would say, has definitely worked well and has made a big difference. But yeah, there's quite a long way to go, and I definitely agree with Sean on this sort of the overdrafts and credit cards. You know, those are the two, but particularly credit cards are really big in terms of the numbers of people that come to us and the percentage of our clients. Those are the big consumer credit elements that you know we really see the problems with in terms of scale. So, and you know, payday has gone down. It kind of, I think payday sort of was very, you know, well, basically didn't really exist, and then it kind of exploded, and it was the increasing numbers. But those things with overdrafts and credit cards have been around for a very long time, and there's less pressure, or there was sort of less pressure. Now there's a little bit more, but for the FCA to or the government to really pick those up. So I think those are two things that we're, you know, very keen on there being more pressure on, saying, you know, partly affordability of overdrafts and credit cards who they lend to, and partly what happens with the people who are struggling with financial
charges, yeah.
Yes. So
Can I just link back to access? So, you know, one of the things that we've kind of realised is that some lenders, some banks, will judge a borrower from a payday company badly, but actually it might have been the absolute best option at the time available. So it might have been the cheapest option compared to a credit card or an overdraft fee, but the kind of concept of payday is so stigmatised that it's actually unhelpful. So using payday, so short-term credit for long-term credit needs, obviously is a mismatch, that needs to be recognised by both the borrower and the lender. But to penalise someone and say, because you had to use payday, you are somehow a risk, without necessarily looking at their entire financial situation at the time and why they made that decision, seems very short-sighted. But we're definitely seeing credit scoring agencies and users of credit scoring agencies making a black mark for using short-term high-cost credit.
Because the old concept of the payday loan was to tie you over until payday,
Yeah.
which is only a matter of maybe 2 or 3 weeks.
Yeah, and it could have been for all kinds of legitimate reasons. So it could have been a 0 hours contract issue, it could have been a bonus coming in late, it could have been an unexpected one-off payment that you need to make for something, which over the year you could balance, but you just hadn't known it was going to happen. For example, my roof is just gone.
Okay, so moving on, I mean, obviously, I think the real issue there is that complete mismatch, that complete inequality of arms between the borrower and the lender. But going on, Joan, could I come to credit unions and perhaps you could say a little bit about the challenges that credit unions are facing and how you can try and overcome them and their role in this market?
I think I can speak for our credit union because, as we were discussing earlier, one of the problems is that not all credit unions can offer the same things. One of the strengths of a credit union is we can respond to our members' needs, the local needs. In our credit union, we realised that people, as far back as 2005, on benefits, didn't have access to savings and loans products. And we introduced a benefits direct account where they could access loans, where they didn't have to have huge savings, because most credit unions then you had to save before you could borrow. And as we already discussed, they couldn't afford to save in the first place, so they were out of that market. We were hugely, we're based in South London mainly, and any high street, you've got money shops, and then you've got the online lenders. So we introduced a credit union payday loan called CUOK. But our interest rate is 42%. And we also then, once people have got that, we try to encourage them away from crisis borrowing onto longer term. So the credit union tries to react to circumstances to help inclusion in our areas and encourage savings. We're a savings and loans cooperative. We've got to have savings to make loans. And we encourage everybody. We can't force them, but we can heavily encourage to save even a small amount while they're repaying their loan. And people on benefits, we try to get them to save £10 a month. And I could bore you with stories of the number of people who have come in, and when I've pointed out that they've actually got more savings than loans, and would they like to clear it, and they've said, no, never had savings before and I want to keep them. So we can do that, but only to our members. And that's not the answer for all credit unions, because they don't all have that capability.
What particular challenges do credit unions face?
There's a cap on the amount that we can charge, on the interest we can charge. But to be honest, we don't really want to charge more than that anyway. There's also a cap on the potential membership that we've got, because Sharon was asking me, would we think of expanding into other areas of London, but we can't, because it's 2 million is our potential membership, not the actual, it's potential. So, 2 or 3 London boroughs and getting, one of the big problems is getting people to know what a credit union is. We can't do a national advertising campaign or even a London-wide one, because we can't advertise, come to your credit union and get X, Y and Z, because the credit union in the next borough, it may not offer those products, and it's very difficult. So it's the awareness that needs to be raised.
And the scale of what you can do?
I'm sorry?
The scale of what you can do. You're talking about limits on the numbers of people you can have.
The scale of what you can do is, the entirely dependent on the amount of membership you've got and the amount of money that you've got. So, we're quite ambitious to do lots of things for our members.
Yeah, well, I know in North London, the one I was in the borough has now merged with other boroughs to create a bigger one.
Yeah, we can do that. I mean, we cover 4 boroughs now. We're the biggest in London.
Yeah, it was on the point about the geographic limitation to credit unions. Would it help in terms of promotion of credit unions if some of those numeric and geographic limits were taken off? So, for example, if somebody from another part of London or even another part of the country wanted to access your products and your services, do you think that would be beneficial if the rules around credit unions
The common
changed?
bond issue is changed. Yeah, I think it would, because then at the moment we're as I said, we're offering services to the MOD. Well, a lot of them are outside of London. Some of them are overseas, but they can all access the products and services online. And there's nothing to stop anybody joining, but there is a common bond issue around all credit unions, all around the country. It could be just that, you all work for the taxi driver, you're all taxi drivers, or you're in the police, they've got their own firemen. And in some ways that's a good thing, because then you're working for your members. I mean, we know a lot of our members by name. We actually know when they're coming in and what time they're coming in. So we do still do a lot of face-to-face, even though everything is available online.
Okay, thank you.
You wanted to come in?
Yes, I'm working on a programme where we work with 10 credit unions each year. So this is year 3, so kind of 30 over the last 3 years, where we support them around financial capability and also their capacity building to develop their own business. So I kind of see credit unions across the country and see the kind of things they're talking about. And the themes are very similar. I think that what we absolutely know is that the credit union's ability to know members and know member needs is crucial. Not all credit unions are very good at that, has to be said, because it requires having a kind of understanding of your community in quite a kind of cross-sector way, understanding different needs at different times. And this isn't the case for kind of Joan, but some credit unions struggle that they know a particular segment of the community really well, and often that's the kind of ageing population, but they don't know the younger needs so well. So when you can see a credit union that's really good at understanding its kind of whole community's needs and responding to them in different ways, that's the kind of models that we should be grabbing. One of the credit unions I'm working with this year has really kind of focused in, again, on the housing issue for young people, and using the kind of the potential of a credit union to say, against your savings, I can advance you money through a loan, multiple of your savings. They're going to build a rent deposit product. And we're tying into that financial education piece about how you go about choosing which property you can afford and running it in a way that's getting good deals. So credit unions have that amazing ability when they do it well, as kind of Joan and her team do, to really serve needs. I think the other kind of challenge is around the kind of the 2 million membership, because when a credit union is doing really good stuff, it can't grow, and so I think that's one of the biggest issues. The other thing around the interest rate cap, what it means is that you can't really kind of bring in a kind of a range of members so easily. So if you want to entice people in who could actually put their savings with you and borrow from you, but they're kind of wealthier, the kind of price cap on a credit union means that you can't really cut your rate for someone who's going to borrow a large loan as easily, because you haven't got the kind of flexibility across your whole product range. So although credit unions are not intended to work as banks and big lenders, they are hampered in many, many ways with these kind of caps on numbers of membership and interest rates. However, one thing I would like to see is a London-wide promotion of credit unions. I agree that you can't say, come to us for this specific product, but you can always say, come to us for like savings and loans. And so, several years ago, New Year's Eve, the entire Tube network advertising, public transport advertising, was given over to Wonga. I'd like to see a similar thing happen for credit unions.
Yeah.
And just on that, in Sheffield, they have this thing that I think was partly funded by the council called Sheffield Money, which is basically a website, and I think they have a high street presence as well, a place where you can have face-to-face interaction, where you can go online, and if you're looking for a loan or some white goods, and then then you go on there, and then they put you in contact with, they have the partners are all community lenders, so credit unions or responsible finance providers in the area. So there is there has been some examples where sort of local authorities have brought together kind of platforms to encourage affordable credit and within the areas for that community. So I would definitely agree with what Sean's saying about if you could bring it across London, that could be quite a powerful way of encouraging that, raising that awareness. Or I mean, I suppose it doesn't even need to be the awareness, it's the awareness of that you can access a loan that is actually going to be more affordable for you rather than use a credit union.
Come back to choice. So it's giving people choice.
And I think that's one last point, if I may. One of the things we're seeing across the country is organisations that could completely legally promote credit unions to their staff or to their customers, so housing associations, local authorities, big employers, always get very nervous because they know that there's kind of regulation around promoting a financial product and service. Now, actually, an employer can, without any difficulty, promote a credit union to its staff, but most find it difficult. And so that's one of the things that we think that we can have more information on. So the FCA making it clear what you can and can't say and getting that out, because I think then that really helps the credit unions not having to make that case themselves.
Oh, we do reductions with, I think, 30 odd employees now, including the GLA, so I hope you're all members. And like you say, most of them, they're quite happy to promote it to their staff and make, but you do get the ones that go, oh no, we can't say that. You know, we can't, because we could get in trouble to, by something could happen and they could sue us. So yeah, there does need to be a little bit more clearance around that.
Maybe the mayor, could I ask a question?
Yes, and then we're back to Andrew.
Just one, when you say 2 million members, do you mean for any one credit union or nationally?
No, one credit union. The potential membership is 2 million.
Is any credit union nationally anywhere near that?
Well, yeah. I mean, we are. Because it's not the number of members that you have, it's the potential membership.
Ah, okay,
Yeah.
that's the thing I need to
No,
understand.
I wish we did have two.
Yes, I was going to say, because it's...
Can I go on to the effect of digital in the financial world and what impact that's had on financial inclusion? Speaking as an analog politician in the digital world myself, has it made things easier or harder?
For different people, either or. Well, I guess just thinking about our research and what we've been doing there, what we see is that someone's digital use of financial services and products is closely linked to their general digital use, and also we know that it's kind of heavily influenced by their kind of route through life. So, irrespective of age, if they've been working or studying or in some kind of activity have been using digital, then they are more likely to be comfortable using digital around money too. With one exception, it's a huge hurdle for anyone to make an online transaction of any kind. So to change provider of a product that you have to pay for, or a financial product itself, or to actually pay for something online. For the majority of people, the first time they do those things, it's a huge hurdle, and kind of face-to-face kind of coaching and support of some, it could be 5 minutes, it could be an hour, is normally required, and we forget that, and we don't invest in that, and digital services really don't invest in that. Young people, although often thought of as extremely digital included, often their digital skills don't equate to these kinds of things. So research around finance or having to pay for something, and also kind of understanding the risks around finance online and their liabilities. So we know that so many young people, they can text, they can message, they can use Instagram and Snapchat and all of these things, but those are not the same skills that you need for making payments online or contracting online. So again, there needs to be a kind of an awareness of that. And then in terms of when we see kind of where people need reassurance, it's in really simple things like making a payment. Kind of making a payment online the big risk for people is paying the wrong person. So we're working on that. So the payment strategy, in the payment strategy forum, is working around achieving confirmation of payee before you make the payment. But we know that those are issues are kind of huge for people. And you might think that they're not really going to stop someone paying online, but they do. They're much more comfortable writing a cheque. So different people, different issues. Yeah, different people, different issues. And I think that's the thing. It's about kind of responding to the individual's need. So rather than saying you should do this, rather than that, kind of saying what's stopping you doing it, what's the benefit to you, and then how much support and hand-holding do you need to kind of get over that individual hurdle.
When on thinking specifically about sort of digital and sort of fintech around affordable credit or credit sources, I think there's been some calls, sort of the APPG on fintech has sort of said that, you know, through fintech people will have better information on people's credit files, and for those people who have kind of thin credit files or small, like, no credit history, then it may help people better assess their credit risk and lend to them. So there are sort of benefits there, but I think the sort of note of caution in that for us is that if you look at the other side, which is not those people that have thin credit files, but those people that have maybe more impaired credit files or have missed payments, and more information on that could possibly exclude more people, if you see what I mean, or those people who were already excluded will continue to be excluded. So I think there's obviously the pluses and minuses on that side. So I think, yeah, like Sean says, it's a solution. You know, it can build some barriers, but it can overcome some barriers for some people. But I think there are those people that are already excluded are likely to either be more. Some people are likely to be more excluded or just continue to be excluded. So I think our note of caution is a little bit like we do hear a lot about sort of fintech and fintech can solve this and fintech can solve that, and definitely it is an improvement, and improvements can come in. But I think our thing is that sort of we were years ago, I think things like Wonga were seen as fintech, and actually that clearly created more problems for people. So I think we think, yeah, there can be improvements there, but I think particularly with access to affordable credit needs to be measured against who is going to be left behind by that.
The other thing is on the digital transformation is you need to focus on the front end and the back end. So the back end of it comes back to those things that I was talking about earlier around, you know, the amount of data that's generated not only through the financial transactions that you do online, through apps or whatever, you know, that's creating huge amounts of data about you and your financial situation, and combine that with other social media data, and that's a really powerful profile that is being built up on all of us. And that data is being used at the back end to segment us all into different buckets, which is determining what types of products and services we get offered or given. And that's all driven increasingly by automated decision making. So there's not much of a human face in financial services. And I think we just need to think about how that's operating. So, you know, it's convenient at the front end for some consumers. It works really well for banks because it cuts their costs. But actually, they're also harvesting huge amounts of information about us, and I don't think, as consumers and citizens, we haven't quite grasped the value of that data that at the moment we're giving away for free or not very much. So I think, you know, in the future we are digital and data citizens, and we need to kind of understand that a bit better.
Any other groups likely to be left behind apart from young people, which is somewhat surprising, I guess?
I mean, older people, you know, we talked a little bit about already, and I think there, it's, again, we tend to lump all older people into a bracket and say they're all the same, but they're absolutely not. You know, whether someone will be left behind will mostly be determined by their economic group and their work history, and whether their work history, you know, whether their kind of daily activities have included digital. So if you think about a postman today, a postman carries a handheld computer that they use to make their deliveries, whereas, you know, my father-in-law, in his day as a postman, never used a computer in his life. So there's, you know, this change over time as more and more digital is used in people's ordinary work life. That changes the way that people feel about embracing digital in financial services. However, the other thing about kind of digital is that if you think about people who are managing on the tightest margins and on the lowest incomes, they always prefer cash. Well, they typically prefer cash because of control. And one area that we can really focus on is using digital in a way that replicates that control. So, for example, again under the Payment Strategy Forum, one of the kind of new initiatives that we're bringing in is a request to pay product. So instead of using a direct debit or having to make one-off payments all the time, you'll be able to set up a standing arrangement with the supplier of your, let's say your electricity, where you agree to pay by request to pay, and they'll send you a request that could be done by letter. So it could be a bill through your letterbox so that you're not excluded if you're not digital, but ideally, to your phone, whether that's texting or some other format like an app, where you'll have the ability to talk to each other about that bill and how much you want to pay, breaking it down into instalments of your choice, saying that you can't pay, saying that you're in financial difficulty and asking for a conversation, all things which don't really happen particularly well at the moment. So we're trying to use digital there to kind of meet people's real needs and how people really need to behave and how they really need to be served. And that's a huge development. We've been kind of trying to explore those issues where direct debits, which of course are a digital form of payment, electronic form of payment that take people's control away, and actually change that and find something that's more flexible. And the kind of real goal there has been to meet people's needs. The only way you do that is by knowing people's needs and really kind of wanting to serve people who are not yet served well. So I think that's the kind of the crucial thing. In order to not leave people behind, providers of digital services need to really get to the heart of why someone behaves the way they do and to not make assumptions about it.
Well, that brings on to the next or last question on these lines, which is the move towards the cashless society. And I think there are two issues. One which you brought up is the question of control and keeping control of your money. I don't like paying with a credit card thing. I like cash, because that's how we've been brought up, and I can keep control of how much I spend much more easily that way. And the other is the way you've got to use a credit card or similar to pay things, like whether it's a parking meter or getting on the bus or whatever. To what extent are people excluded as a result of that?
Well, anyone who hasn't got an electronic form of payment is excluded. I described for you just this week, I saw two people have to get off a bus. And ironically, they had a payment card, but only one, and they needed to make 2 bus fare payments, and they had no cash on them. And because Transport for London won't let you use the same card twice on the same journey, they had to get off. So there's kind of this whole way of thinking, which is I set my policy to suit my needs, but actually we need to be changing that to suit users' needs. If you haven't got an electronic payment method, or you don't trust your electronic payment method, and therefore you want to use cash, it costs you so much more time, because you've now got to go somewhere and you've got to put down a £5 deposit to get an Oyster card. And if your Oyster card malfunctions, then you've got to pay another £5 deposit because they won't swap them over. So now you're giving them £10 for a short period of time on a tight margin. That's an enormous amount of money. So there's so many ways in which these incremental time and cost exclusion issues build up for people. So our goal has to be to do two things. Where someone absolutely, for a very personal reason or a very personal need, needs to continue to be able to work in cash, we have to be able to facilitate that. And we have to make sure that the essentials of life, that they're not penalised for using cash. That's a very hard ask. It's a very tough ask. But particularly hard to ask that in an economy that is driven by profit maximisation rather than social goals and social outcomes.
Does anyone want to add anything to that?
I think we're coming on to the next section around financial education, advice and support, and I suppose one of the things around transitioning to a cashless society is, how do you teach children and young people the value of money, and when it's so much less tangible, and what does that mean for, I think we need to take into account how young people and children are learning and using money now, and it's so different. I mean, I think that is one of the massive changes in the past 20 years, really. And the acceptance of credit, the acceptance that, the exposure to the online environment where you've got in-game purchases, children are being targeted at a very young age to be spending money which they have never touched.
I think it's a generational thing there, isn't it? I was brought up the basic, if you can't afford it, you don't buy it.
Yeah, you can,
But,
my dad will say you can have anything you can afford.
Yeah, but life's moved on, and I think partly because of, well, for graduates in particular, the way they come up with these huge debts and it's all the way it is. And I remember a few years ago when the banks tried to abolish cheques and chequebooks, there was a huge outcry, and then they had to back down. But I suspect that will come back again before too long.
I mean, what sticks in my mind is we did do lots of research on people in debt and who are accessing debt advice services, and we interviewed one woman who was in credit card debt, and she said, and actually it was some work we did for Step Change, and she said it really struck home to her that she had she needed to sort this out, because she went out with her young son, who's about 4, and said, we can't afford to go to McDonald's today, and he said, that's okay, mummy, you can put it on your credit card. And she said at that point the penny dropped, that this wasn't just about her and her debt problem, it was about how she was relating to her child and how he was learning about money.
I suppose that comes on to your section on education, doesn't it?
It does indeed. And just before I bring Sean in, I just wanted to say that we're actually having a round table discussion on financial education on the 12th of October. We've got London schools and organisations that run initiatives for schools to teach financial literacy. So that's coming up on the 12th of October. But Sean, handing over to you.
Yeah, I just want to focus on financial education. What role do you think financial education will play in helping young people understand how to handle their money? Because the environment is very different now. I remember when I was at university, I had a car and I bought petrol on my credit card, something I wouldn't do now.
A car?
Yeah.
You've got a bus like me.
Yeah, but I
Hitchhike like me, actually.
but I then realised why I did it is because it kind of felt like magic. It deferred it. And your comment about the lack of physicality with credit cards, touch payment, your phone, your watch. I watched a guy walk out of the tube and pay with his watch. Is that it's now hard to teach, I have 2 small children, the value of money, because there's no physical transaction, there's nothing to count. So does that make financial education more important now than it's ever been?
I think with financial education, it's about having the right type of education at the right age. So I think teaching young children at age of 6 or something about credit cards or bank accounts when they're not going to be using those products for quite some time probably isn't going to stick with them. I think from a personal perspective, I think giving people really good basic skills, numeracy, literacy, and being critical and analytical, I think developing those from a young age is just as important as when they're getting to the point of taking out and thinking about financial products and services, then it being kind of teachable moments where you're getting people at the right moment to help them develop their financial capability. So we know that young people's financial capability is lower, but there is a reason for that, and that's because they haven't been exposed to making those financial decisions. So I think it's about getting it right for the point in time at which you're delivering that education. I think it's fairly well known, and I'm sure it will come up in your October roundtable, that it is now on the curriculum. I mean, it's different in different parts of the UK, but actually that's a fairly, as Martin Lewis has said, it's a kind of Pyrrhic victory if you don't have the resources and you haven't engaged teachers in being able to deliver that in a meaningful way.
Because it strikes me that many of the problems we're talking about, some are around debt and others around lack of access, they're cultural. So if someone had told a young person, in order to use the financial system in the future, you need to build up the right documentation, that young person may have then gone away and done that. And I wonder, is there any evidence that this is happening in the school, and that the the inclusion of financial education in the curriculum, is that having any positive impact? Are we seeing that come through?
I'm not sure that there's any evidence of the impact of it yet, because it's quite an early, we're at quite an early stage in terms of it being implemented. But actually I think it's a bit wider than that, because there are young people who won't have a very positive engagement with school, and some young people who will spend very little time at school. So it's thinking about how do you reach young people and children and young people in all range of situations. So particularly I think there are issues for young people who've been in care, for example. There is some quite strong evidence that they, for all sorts of reasons, do struggle financially because they have been looked after for all of their life, and then, you know, at a certain age they will be expected to do it themselves. So actually I think there are some groups who actually need much more intensive support. I think the school piece is really important. As I say, I'm not sure there's much evidence about what impact that's having at the moment. The Money Advice Service is doing a lot of work with schools to try and see what works in terms of delivering financial education. So I think our evidence base will get better over time. I absolutely agree that school is the right place to be doing it. We need to think outside school as well, and we need to think, you know, what's age appropriate and what makes sense for people. And thinking about that changing context is all part of it. So it is about the content being right and being up to date.
Is there any evidence, or do any of the groups that any of you deal with, credit unions, etc., earlier on you seem to assert that you feel like you have more of an educational role than maybe a bank would with your customers? Is that correct?
We've got savings schemes in several local schools, and we're working with a church group called Lifesavers, where children learn about money. They come and they have a collection point. The children run the collection point. They come into the credit union, see how it works. So trying to engage them from a young age to know what money is. We don't do much in the education way, although we're looking to get some funding to do it, to take them on to the next level. Like you said, building up the documentation they'll need. That's not a role that we've taken on yet, but you know, they're all things that they need to keep. It's not just about taking money off them every week. It's about trying to make them know what money is and make them aware. And we've got a teen account now, a bank account, where there's obviously no credit involved, but where parents can put pocket money or an allowance in, and the child can use it like a credit card to get used to doing those sort of transactions, and you know, get used to the fact that if you keep using it, the money's gone. So we can do that, but we're not
shock,
you know, we're not sort of educators in that sense, but we are working with the schools.
Because sorry, go ahead.
So I think on financial education, we need to break it down into some kind of key topics. Firstly, in this country, we've put a huge amount of money into financial education. I'm on the Financial Capability Strategy Steering Board, and we were talking the other day about, do we know how much money goes into financial education? And there is not a published number, so the Money Advice Service is doing some research for us. So firstly, the huge amount of money that goes into it. Secondly, the almost total lack of proper evaluation, and the Money Advice Service is trying to tackle that. And then thirdly, based on that, what works for whom, when, and therefore why would you invest in that particular kind of intervention at any given moment? We're so far away from knowing those things.
Okay.
So I would say that everything that Sharon said about really good targeted information at the right time there's the kind of rule of thumb, but there are some building blocks that go behind that, which is when we are asking young people to leave school, care, homes, and go out into a very predatory world around money, because essentially in our society, this is the deal. You've got some money, I'm a business, I'm going to try and get it off you. Yeah, that's the deal.
Yeah, fair enough.
And we have corporate social responsibility, and we have responsible business panels, and we have all kinds of ethics and codes, but look how many times a firm of any kind, not just a financial services firm, but a firm will overcharge because it can, because that's what our model says is possible. And so we've got to teach not just young people but adults that that's the game, and that their kind of job, their role in the game, is to get what they need, to get their needs met, and ideally to do that for the best price. And that actually that's what we're talking, that's what we're teaching. So that's the kind of underlying ethos of Toynbee Hall's financial education programmes, is waking people up to the real situation. The number of times we hear people say, oh, I bank with X bank, or I get my energy provided by X provider, and I've done it for years, and they expect loyalty, and that loyalty just doesn't exist. It's an old concept in financial services and other providers that loyalty repays
I just
the
experienced
individual.
that with my car insurance.
Yeah. So these are kind of the truths that we need to be waking people up to. And that's not suggesting that we have to change the whole economic structure, but that people need to be aware of it and kind of alert to it. So it's not just about numeracy,
But what I'm
it is
interested
about
in
culture.
so you talk about breaking it up to topics, and we've had a conversation that says it has to be appropriate. And the next thing is, where are those transition points?
Yep.
And is there anything in place? So I've been a youth worker for 25 odd years, and I've actually seen financial capability go down. You know, I spend my time explaining to people that, you know, your store card doesn't make it cheaper. Credit cards are not a way to buy petrol, for instance. You know, I have those conversations with people, and it strikes me that, you know, there's a piece where you're saying to very young children, this is what money's for. There's a piece of saying to children, you know, beware, because you are just about to transition to adult and you're about to get bombarded. But do we work with those things? And in these notes, and in my sort of small experience of these things, we don't seem to talk about family. Because most of the children I know who are then have any sort of level of awareness around money, it didn't come from school. And I happen to know the two local secondary schools close to where we operate have good financial training. They still more talk about the lessons they learned from their family. Mm-hmm. It could be emotional link, I don't know. Or things that they've gotten out of the community. So our local adventure has this thing about invest in yourself, save for yourself, and they speak about that much more than they do what happened in school. And are we, first question, could the mayor be doing something significant? Because I think actually the mayor should do something about credit unions. I'm a great fan of them. I think they suggest a community approach to money. And could we be doing something as a London Assembly to highlight this issue amongst young people, but not only young people in school, young people who don't attend school for every reason, and young people who are just beyond school age? And if so, what?
I don't know is the answer to that. It comes down to engaging with the people. Southwark Council, over the last 2 years, have given a voucher to year 11, is it? I'm not really sure. Children. Kids about 11 years old, so I'm assuming it is. Voucher for, the first one was for £15. Take it to your local credit union, open an account, and it's yours. Put it in there. And I think the take-up was something like 20%. They were giving them free money, and it really was hard to get them to come. The second round of it was much more successful, but they had to do a lot more work into, you know, and at some of them, even in schools where we were doing a collection, didn't come and, you know, they said you can take it to the collection point in your school. So it's not as simple as, you know, come on, this is it. You've got to engage the child and the family, because in this case the parents had to be the trustees on the account, and yeah, it was very hard to give away money. So it's really important to have these outreach programs, but maybe a London-wide approach would be much more successful, because then it could get so much
raise the profile.
more publicity, more profile, you know.
I think it's one of the Child Trust Fund, which got scrapped some time ago. The original idea behind it was that actually every child having a child trust fund, whether it, you know, however it was saved, and it wasn't about the money that was in it, it was the fact of having it, could be a kind of route into kind of talking about, understanding how you feel and think about money, and understanding, the value of saving and things like that. So that would have been a common thing to allow a kind of programme to have developed, but unfortunately it never came to fruition. But I think there is something about understanding the different touch points, whether it's family, whether it's community groups, going to Scouts or Brownies or Guides, thinking about where children and young people have those touch points, and where, money conversations could be happening. Because I think it's, as much as anything else for children and young people, it's about having good money conversations and getting to, talk about these things, so that they are learning good money skills in a way that perhaps is informal and maybe kind of complements what they're learning in a formal situation. But, it's very, I think the point's been made a number of times that, you go to school, you do history, geography, French, German, you don't come out being experts in all of those subjects. So doing financial education in school isn't going to make you a financially capable person. It might be one part of a whole kind of jigsaw of things that make you financially capable. And part of what makes you financially capable is what's in your head and what's in your heart, and how you think and feel about money. And I think perhaps for children and young people, that's as important as the nuts and bolts of what a credit card is or what's the savings account. It's, how do you think about money? What do you think about, wants and needs, and what you're asking for and what you have? So I think there is something about the psychology of money that's really important to convey, and the emotions of money.
Would you say, because for me you've really struck a chord there, because I speak to lots of young people and money conversations tend to be rich, how am I going to get rich? There isn't that sort of low level reality. And the sort of question, the two things I want to say, is that work part of the financial training that is out there, that psychological element? Because young people who get in trouble with money, it's normally a psychological thing. I shop to feel better, or I just haven't sort of calculated that there's an interest rate on this. And also, is there any barriers that we could remove, that the mayor could remove? Because I actually think a 20% response is quite good. If you're in politics, you'll realise 20% response to anything is really quite good. Yeah. I think it's quite good, and obviously it's something that can be built on. And I wonder, is there anything we can demand of the mayor? Because to me, this would answer many of our social inequities, around health, etc. Often it boils down, do you have any cash? Is there anything that the mayor, the GLA, and or the London Assembly could do to help promote financial education amongst people in London, but young people in particular? And what are the barriers as you see them to, getting these messages across? Because it's quite astonishing to me that people don't want to know about money. This is astonishing to me.
I think, go on, sorry.
Oh, well, I was just going to add one small thing about, in terms of teachable moments, and it might be not the best solution, because I know that they may have, I'm going to talk about children's centres, and if you're talking about people learning about money from their families, obviously schools is a way to get to children, but if you're talking about new parents, then sort of early years, and sort of the earlier the better. And obviously, and we know that sort of having a new baby is often one of the things that can cause a lot of financial difficulties. So I think that could be an area where, I don't know how many children's centres there are left in London, but where things could be, discussed, or some kind of promotion could go on, talking about trying to get to families. The only other thing I want to say about financial education, and not that I completely agree with you about how important it is, and for young people, and where people don't have those, people don't have the skills or the understanding, that it can definitely cause problems in the sense of companies or interacting with financial services and getting into a lot of difficulties. We see that through our clients. But I think, just to make the point, that we also see financial difficulties aren't always caused by, or problem debt is not always caused by people who are unable to manage their money. It's often that people are making quite rational choices, or it's just that if you're on a very persistent low income, or you're on a very small income or tight income, they're often very good at managing their money. I think is just a kind of point to be made as a slight counter, that yes, financial education is really important, but it isn't going to be the solving of everything, and financial capability more widely in terms of people having financial resilience and savings and access to products and services that aren't going to get them into difficulties is the kind of broader issue that I think is also important.
I wanted to come back to the Southwark scheme and just ask Joan, when they did go back and put more intensive effort into getting people to take it up, what was the take up then?
I don't know the exact.
You don't know, okay.
Fiona,
And-
but it was a lot
Yeah.
higher,
It's a
and
lot
we're still
higher.
getting them coming in now. As the children are going back to school,
Right, okay.
we'll be getting.
So it's a
more
relatively new
coming.
scheme then?
It's sort of, I think it finishes, the vouchers expire, I think it's the end of October, but
Okay, so you
then
might
they
see
kept
a bit
them
more of a
open.
spike
Yeah,
then.
and then they
Yeah.
kept them
And then
open.
the other thing was whether 11 was too old and that it ought to be at birth or younger, whether by the time children got to 11 they've already got into what the optimum age would be. If you could choose an age, what would it be?
I mean,
think Sian's waving and saying 4.
We start
Yeah.
in schools at 5, you
Yeah.
know, with the things. But I think the thinking was, as they were transitioning into secondary school, to get them to have a
Yeah,
the good, you know, one of the other things that it was aimed for, it wasn't just aimed at that, and which was very successful, was engaging families, because we saw quite a lot of, you know, a lady would come in with the child's voucher.
yeah.
But I saw one lady, she signed up and opened accounts for 5 siblings, and she opened an account herself. So 7 people joined up from that, and so that was good in the, you know, it was getting the families involved, and getting the parents involved too. So it was, from that point of view, I think it was a great success.
What Sian's indicated, and then Andrew.
Sean, I love your challenge. Like, what would that be, that thing? Can we take it away and come back to you? And I just want to say one thing, which is that of all the work that I've seen with young people, and we do some, and we've worked on it for many years, is that when you start with that young person's personal aspiration, and you start from there. So you said, you hear young people talk about wanting to be rich. That's where I'd start with them, because that's what they've articulated. And I think money, and Sharon said it really well, and it's in the heart of all the work that we do, is that you know, money is simply a form of transacting, but actually it's become incredibly complicated and emotional. And so if we forget that and we try and do anything without taking the human heart and the human mind into account, it fails. And that's why current provision of education, financial education in schools, is not particularly good. And I say that hasn't been robustly evaluated enough to put my kind of stake on that, but that's what I would say, is because it doesn't start from there. It tends to start from facts and figures, and this is how things work, not how do you function, what are you trying to achieve. And where we see really good successes, and I would say I'd include our own financial education for adults, our Money Mentor programme, is starting from people and saying, what's your aspiration? So we run a programme training up people to be community money mentors for that exact reason that you articulated, which is that most people get most of their financial knowledge and skills from people they know. And so we had this idea that if we inoculate the country by kind of putting in really good community knowledge, and then you just build a critical mass. So we work on all of those principles, and I think starting with where someone is rather than what you think they ought to know, understanding them as an individual, and then saying, right, so where does money get in your way and where does money help you, and then how do we advance that for you by skills and knowledge? That's where financial education works really well. There's a really good programme I'd get you to look at, and maybe Lloyds will be coming to present on the round table, but we worked with them. We're not on part of the programme anymore, but it's still fantastic. The Lloyds Money for Life Challenge, which you may already know about. Well, the lovely thing about that is that a group of young people in a community can apply for a grant to do something around financial education, financial capability for their community as they see the needs. And it's incredible. The things that have come out of that are amazing. It's a really good model. I definitely recommend that you look at it.
Could I just say one thing on that? Because I think one of the issues is that there's lots of programmes and initiatives that go on, and I think one message that I would say to the Mayor is that there's lots of different programmes and initiatives. They're quite disparate. They're generally short term. Can you think long term about something? Because I kind of do worry a bit about, you know, you have a particular community and you kind of helicopter in different services. They're there for 2 years or they're there for 3 years and then they come away again. And what I worry about is what do the people in those communities think? Oh, well, here's another one. It's not going to be here for very long. It's going to be here for 2 years. What's the point in engaging? Yeah, I engaged with that, the one that came before, and that was fantastic, but now it's gone. So for me, there's a real issue about continuation and kind of commitment to those communities so that there is a kind of long-term, persistent and consistent working with them. Because what we know from all the evaluation evidence is it takes a really long time to build up trusted relationships and to get people engaged in communities because, you know, they've got other stuff going on.
That's why working families is one of my worries in youth work, in every subject, not just this one. We constantly work with the children, but you need to work in the community, the family that they're going to be around all the time because they will be there forever.
Yeah.
I mean, my mum is still haranguing me now about finances. You know, she's been doing it all my life. So that's why I'm as concerned about how we work with the wider community, not just children.
Yeah.
Yeah, well, just a quick one. I mean, I'm talking about education, financial education in schools and the community and so forth. One thing that worries me is the extent to which that message is undermined by the enormous debts that students come out from university when they're going in. And they think, well, we were told to manage our money this way and that way, but I'm going to come out with £60,000 worth of debt. Doesn't that just knock a hole in the whole thing that you've been trying to convey?
Potentially, but you know, good financial information and education makes it clear that there's two different types of debt. There's debt that's an investment, and in this case, that if the bet doesn't pay off, you never have to repay it. You know, that's the thing. Lots of people don't know that, but that is what Money Saving Expert is making. He's trying to make really clear to young people that, you know, debt from university is a debt that you only repay when you get to a certain income level. And therefore it's an investment in a higher wage. And then there's other kinds of debt, so debt that is money you can't repay, or money that has no utility, you know, debt that has no utility. So I think that's really important. However, if the kind of the motive behind the question is it fair to put people into that position when we're trying to get people to be financially healthy?
That's a political question. I have my
Probably
views
not.
and others may have different views, but I'm just more interested in how it plays out with what you're trying to do.
It's about understanding that not all debt is bad, and that that borrowing money for any purpose comes with responsibilities, and you need to be able to understand those responsibilities, understand the terms and conditions applied to them. So, in and of itself, it's not undermining of financial education. It is undermining of education.
Yeah, that's a different question.
I think, sorry, I was just going to say from the research that we've done, we did some analysis which looked at young people 18 to 25 divided into people who'd gone into higher education and people who hadn't, and there was much higher risk of debt amongst young householders who hadn't gone into higher education. So they are a group that don't get enough attention. There is a lot of attention on student debt. There is not enough attention on young people who don't go down that route and who may be going into independent living without the skills to manage that. And the way that those people learned was by experiences and bad experiences, and that taught them a lesson, but it was a very hard lesson.
Brings us neatly onto our next section, which is on debt and debt advice. Sean.
So what debt advice is there available in London? And are they both in terms of prevention and crisis support as well? And how could that advice be improved? I'll start with Laura.
Okay. Well, we're Step Change is a nationwide telephone and online service, so we will help anyone from anywhere, but in terms of London, I think last year we saw over 100,000 people from London, and London was the highest in terms of number of people that we see, and second highest in terms of population, in terms of clients where we see across the country. So there's clearly something significant in London associated with debt problems. In terms of debt advice, there's other providers like National Debt Line, which is like our online telephone service. So there, but I think in terms of London specifically, there's a capitalised partnership which Toynbee Hall are heavily involved in, so it's probably, yeah. So it's probably better for Sian to pick up on that one.
So, Toynbee Hall runs the face-to-face free debt advice provision for London, funded by the Money Advice Service, so the levy through the Money Advice Service. And that's run through kind of, on average, 28 organisations across London that form a partnership under our leadership. And that provides a session, so a one-off session if you're kind of in the position where a one-off debt advice session would be what you need, or casework, which is where there's complex debts and you need to be able to see an advisor multiple times, and that can go on for as long as you need it. So in the kind of question where you're asking, is it both crisis prevention and preventative work, there's very little provision for anything that is preventative. Doesn't mean that we don't want to be able to offer it, but it's much harder because if there isn't already debt, then kind of what are you kind of judged on? That this household doesn't fall into debt, but they're not actually in debt. So how can you be certain that they wouldn't fall into debt anyway? So when you're talking about preventative work, we tend to think of that about kind of financial capability or kind of financial guidance, and then debt advice dealing with actual debts. So face-to-face provision anywhere in London for free. There's also other providers. So for example, some councils directly fund debt advice. Some housing providers directly fund additional debt advice. And they do that because they're owed money from people. So, you know, it could be council tax arrears, it could be housing arrears, and they want those people seen quickly, and so they fund additional provision. So this is all face-to-face, alongside, you know, the online and telephone advice that you can get from Step Change and National Debtline, and also Citizens Advice have a telephone advice provision as well. So there's a lot of provision. We would say that there's probably still not enough to meet true needs, and there's certainly not enough if we wanted to go down a very heavy focus on preventative work. It's very hard to get someone to come in to get advice early enough. So certainly it's very hard to get someone to come before they're in formal debt. So that preventative work is incredibly hard to do. People are embarrassed, they think there's a stigma, they think that they'll find another way to deal with it. They're terribly worried about their credit score being affected, so they'll try anything to manage the debt so that it doesn't fall into a kind of an arrears position where it will affect their credit score, because they're living often by using credit, so they think that that's the goal, is to keep their credit lines open, when often we'd say, no, come and get some debt advice. It's a very complicated story to tell to people why they should come early. And secondly, most people come when it's just got so out of control that it's incredibly complicated to unravel. You know, we tend not to see people either face-to-face or, I'm sure Laura will say, kind of on the line, with single or simple debts. It's incredibly complicated. And in the past, that was exacerbated by people borrowing from multiple lenders. We've seen less of that. And increasingly we're seeing people coming because household bills are too expensive and they can't physically live within their means. It's not about a lack of knowledge, it's about things are just too expensive.
Can I just say, in terms of, you've asked a question about how debt advice services could be improved, and I think, so going back to 2012, 2013, legal aid was abolished for all debt, apart from some housing related debt where there was a risk of eviction. So legal aid for debt services was a really big source of funding, and it funded in particular some quite specialist debt advice caseworkers. That has completely gone, and that will be, it's across England, and it will have affected London. So I think there is a real question in my mind about, you know, what specialist debt advice services are now available that are helping people who don't have kind of straightforward, I don't think any debt's straightforward, but where their debt problems are complicated because of legal issues or because they've got very complicated debt problems, there might be tax issues in there. It's really hard for people to get any legal help now, which is specialist, and that would be a really big question for me about, you know, what's happening in London and what could you do to support that. And the other thing, which I think I'm slightly jumping ahead, but what the debt advice services and what people's experience is that actually dealing with non-financial services creditors is one of the most difficult things. There is really poor debt collection practices and bailiff use in local authorities. That's one thing the Mayor could look at, is how local authorities are using their powers to collect debt. There's evidence that, you know, for council tax arrears, councils move really quickly because they need the money. It's very much a kind of automatic process that doesn't allow for any much human interaction. And actually, if you looked at the difference between non-financial creditors and firms that are regulated by the FCA, the firms regulated by the FCA do a much better job. And actually, the non-financial creditors have been really slow and reluctant to engage. So the Money Advice Service has been doing some work to encourage creditors to share good practice, whoever they are. But it's been really slow going.
Cheers. Thank you.
Yeah,
I don't know if Laura would want to...
we definitely, one of the big issues is council tax arrears, as I've said before previously, has increased significantly, and one of the particular issues is bailiff use by local authorities, and we've been campaigning more broadly around bailiff regulation and better bailiff regulation, having a kind of independent regulator of bailiffs, which would make a big difference, but also talking to local authorities and looking at helping them understand that the kind of journey that a lot of financial service providers, as Sharon says, have gone on, that actually, you know, aggressively collecting the debts is probably going to get people into more difficulties, whereas better forbearance, helping them pay more affordably, can improve your debt collection practices. So for example, in Lambeth Council, I think they've reduced their bailiff use for debt collection of council tax arrears to 0, but they've actually managed to increase collections. So I think that is definitely something that if the Mayor or if the Assembly could bring councils together to discuss, or to see how there are different ways of collecting council tax that don't include the kind of additional stress and real harm to people that bailiff use can cause, as well as the additional fees and costs that adds. So yeah, that's definitely a really key thing. Just to come back on sort of improvements to debt advice, one of the things that sort of linked to this is one of the things that we're been sort of campaigning on, and we're keen on, is this concept of breathing space for when you're seeking debt advice. So when you seek debt advice, you're given you're put on a sort of statutory breathing space scheme where you're given your creditors' interest and charges will be frozen, and you'll be their enforcement practices will have to be stopped to give people a period of time to recover. That could be sort of 6 months, up to 6 months, a year, to recover and get back on a stable footing, and then help them possibly repay their debts if that's possible, or turn to insolvency or other options. So that's one of the big things we think in terms of what the solutions are for people when they come to debt advice. There's obviously bankruptcy and insolvency, and that will give you that gives you that statutory protection, but that's only really for a certain group of people. Not everyone can take that option or wants to take that option. For those people who are actually willing to repay and engage with their creditors, they're in the kind of precarious position where their interest and charges may continue to be added, they may still be subject to enforcement action, even if they're going through the process of debt advice and trying to do the right thing, so to speak. So that's another thing that we think that is, if the Mayor or the Assembly could sort of put their voice behind, it would also be quite powerful. So it was in both the Conservative and Labour manifestos, but we're still sort of waiting for some movement on that.
That's all written down. Thank you, Sean. You didn't want... No. So that moves us on to our last section, which is the role of the Mayor and local authorities. And certainly, I mean, my head is spinning with the amount of interesting things that we've heard this afternoon. And, you know, sort of we know that we have a Mayor who has said he's making financial inclusion a priority, so that's positive, because we hope that there'll be open ears to the things that we're learning from you and the things that need. doing, I mean, there's a couple of things in relation to the mayor that have that you've said that I've been wondering if it would be helpful. One is whether there's a role for the financial tech companies to have a kind of, you know, a sort of an ethical lens for the way that they develop their products and apps and things that if no one is making an expectation of them, that they will be thinking about financial inclusion and, you know, the ethics of the products that they're developing, then maybe they're not going to think about it for themselves, and whether the mayor can actually foreground the need to think about financial inclusion issues and sort of the ethics around the products that they're developing, whether that would be something useful. I also think that you know, the Oyster card, the story you told about someone on the bus having to get off with just one means of digital payment between them, that's something that, you know, it's a systemic problem that ought to be fixable. It's within the mayor's powers to fix things like that. But so my question is, is there anything that hasn't yet come up that you think that the mayor could be doing to enable more financial inclusion?
On the fintech point, I think there is an initiative that the Financial Inclusion Commission's been supporting called Fintech for Good. So it would be worth talking to the Commission Secretariat about it, because that is very much about looking at how fintechs do, I think you're absolutely right, look through that lens. I mean, they're very concerned about kind of gaining traction in the market, but some of them have been kind of engaged with the Commission. I think from a kind of, you know, what does good look like, then actually it's their business models that are the crux really, because if they're based on kind of opaque, commission-based business models, that's kind of not what we'd want. We'd want to see new business models that actually were ethical and reasonable, not just replicating old business models that we know kind of aren't very good for consumers.
Mm-hmm.
So I think that on the fintech side.
Yeah. Is there anything else for the mayor before we move on to the next?
So I think one of the key things to think about is the kind of footprint of a community, and to kind of take a place-based approach, because when we think digitally, we can kind of forget that people live and work and kind of do everything else in a community. So I think there's something around having a kind of London-wide kind of code of conduct and set of standards around, you know, what should be available to a community to see it thrive. And that has got to be that there's access to financial products and services that work for that community's needs. And one of the things that we've struggled with is the idea of bank branch closures and having no control over that as a country at all. It's all based on business grounds, which one part of my head completely understands, but then seeing the impact of that on communities, I think that that's something to kind of consider. What are the kind of minimum requirements that any geographical community requires, and how could the mayor and the kind of mayor's powers support that? And obviously, you know, kind of business rates are one of the things that can think about that. The other thing is that we've seen that it's not just fintech that can solve things. You know, there are innovators within existing financial services providers, and so thinking about what good looks like for the mainstream is really important, because it shouldn't just be fintech challenges that are part of the kind of the goal of tackling financial exclusion and increasing financial inclusion and financial health. I think there's something there about having a conversation with well-established companies and saying, you know, we have always been the centre of banking, and as a city, it's a kind of thing to be proud of. How do we create a kind of inclusive banking and inclusive financial services sector that people want to be part of and want to speak well of and build trust? And what would that look like across London?
Mm-hmm.
I think, sorry, just to jump in, is the other thing is around looking at the great organisations that you've already got on the ground. So you've got some great responsible credit providers in London. You know, what do they need? Because social investment is a really big issue for some of those lenders, where they're perhaps not member-based lenders, but you know, they do struggle to get social investment in order to expand. So I think it's thinking, you know, what does the infrastructure already look like, and how could the mayor work to strengthen that infrastructure within different communities? And I think the area-based approach is a really good one, because it's like what's happening, what works in one community, and can you replicate it in another community, and what would need to be in place to make that happen, and can you kind of join them up so you have got end up with a London-wide approach.
Then if we start thinking about local authorities, we've heard the problems of bailiffs being brought in, in a slightly insensitive way around council tax collection, but we've also heard about good practice in terms of providing debt advice. Someone used the word trust just now. I can't remember who, I'm sorry. But thinking about local authorities, it just occurred to me that many local authorities are looking for things to happen in their libraries, and libraries are places of trust. And I just wonder whether there's, we're talking about bank branch closures and, sort of problems with debt advice. That's just something that's just been occurring to me as this conversation has gone on, whether there's something that local authorities could do with their library buildings, connecting with financial education or debt advice, or even credit union or bank, the opportunity for that sort of face-to-face service that banks might provide. Sorry, it's like just comes to me, inspired by everything you've been saying. But is there, is there anything that you think that the Mayor could do to help local authorities across London to promote financial inclusion?
One thing, so today a report came out by the Centre for Responsible Credit looking at local welfare schemes, so the local welfare provision that provides, that used to be sort of crisis loans and community care grants that were provided by the government more nationwide, and that was devolved into sort of local authorities providing their own local schemes. And the report was found that in sort of context of uncertainty around funding and funding cuts, the now sort of 2/3 of the schemes are either closed or significantly reduced, and this is a really crisis support for people. So it's for people fleeing domestic violence, it's for people who are really struggling and need a kind of emergency grant or support. And I think there could be, in terms of different local authorities, I think the two picked out that I saw in the report was in London was Haringey, I think, that have had to close their scheme, and but Islington, who has a very strong scheme that was actually responsive to the Finsbury Park terrorist attack there, that they used the scheme to help some of the people that were involved in that. So I think there is, I'd say that we see those local welfare schemes, they're the really crisis support that can actually stop people from spiralling further into sort of debt problems and help them sort of get out of a really difficult situation. So I think one thing that the Mayor could do, I don't know how possible it is, but looking at local welfare across the different schemes across London and seeing if there's any way of pooling that or creating some kind of way to ensure there's some consistency, or there is some of that emergency support across London, that could be one way of looking at that.
That's great. Anything else?
Something, I was involved, it's probably a couple of years ago now, in Scotland, in Glasgow and in Fife. They ran some local authority organised kind of evidence gathering sessions around, it was particularly around higher cost credit, and one of the things that the councils did up there was to make it impossible to access online sites related to high cost credit within council offices. So they kind of barred people, so where members of the public were going into libraries, for example, or other council buildings, then it wouldn't be possible to access some of those sites. I don't know if they've evaluated it in terms of what impact that, but I think they felt that was a positive thing they could do. And we were talking before the session started about the rise of online gambling, and I think that presents particular risks, including for young people, where Joan was saying, how common it is for people to be coming for loans to the credit union, where, those loans get refused because they can see on the bank statements that they're online gambling, playing bingo, or, do online casinos and that sort of thing. So I think there is something about, what's happening in other areas of people's lives that is affecting their financial health. I think we've seen quite a lot about fixed odds betting terminals, but actually there's a lot about the online space that needs to be looked at, and the Mayor might want to be looking at that in terms of how people access those services and whether they can do it through public access computers.
Great. One more.
I'd
Sean.
flag two things. I'm not knowledgeable enough about the Mayor's powers to know where we can make a difference, but I think these are key points. Identity, so proof of identity. So supporting councils to help particularly young people be able to prove their identity. I mean, we should be able to do that in this country, and we can't, so there. And secondly, I'll send you some information. I've just come back from a trip to Australia where I've seen some fantastic work, both around where the last bank in town has had to close, and they've opened the branch out to community organisations who've then been able to take on the role of being kind of financial services providers and information providers. Some great models there might be worth looking at. And also the universal credit issue is going to be particularly kind of challenging because someone can have up to 6 weeks with no income, and the welfare scheme and the kind of the understanding that prevention is so much better than any kind of cure here, making sure that where local authorities know that they've got local residents moving onto universal credit and that there will be a 6-week gap in their income, thinking about how we tackle that together.
That's something we're already working on with local authorities and housing associations, and that's where the Jan-Jar account comes in. But even the ones who are not transitioning until next year, we're trying to encourage people to open current accounts so that by the time they are in that situation, they're used to having, you know, a current account, they're used to having a card, they're used to using an ATM, so it's not such a shock. And the 6 weeks is what it should be. One of my neighbours was 12 weeks, and we're looking at other schemes where maybe we can make small loans, weekly loans to get people through that gap, but that's sort of something we're still working on. But that's something that does need, universal credit is going to have a huge impact.
Sorry, could I just one more thing, which is on the kind of banking and bank account point, which somebody made the point to me yesterday, so I can't claim it as mine, but he was saying he was surprised that the banks haven't been challenged on the Equality Act in terms of bank branch closures, because, you know, people with protected characteristics include people who are older people, ages in there, and disabilities in there. It's mostly for public services, but, you know, is there anything the Mayor could do looking at that legislation to say, well, you know, essentially financial services are an essential service, they are a basic service. Now, can he challenge the banks on, you know, what reasonable adjustments are they going to make to help some of those people who would struggle to access financial services? We accept that bank branches are going to shut. We accept that most people are moving to a more digital kind of situation. But actually there are times in all our lives when we will need to speak to somebody, and that's particularly the case for people who are older and people with disabilities. So, you know, what can the banks do on that? There's been so many discussions about things like shared bank branches that have never gone anywhere. They've been going on for about 20 years. And I think, you know, it's the banks really need to be challenged on that.
I'm now going to move on to the final thing, which is that our next meeting we're going to actually be looking at community banking. It's something that the Green Party sort of suggested in its manifesto, mayoral manifesto, last time, for the last elections. But there are lots of local authorities that are investing in community banks. Warrington Borough Council has invested £30 million in a community bank. Portsmouth Council is investing in a Hampshire community bank. And community banking is a model that allows the provision of banking services to people who find it difficult to access banking services. And I just wonder if you have any thoughts on community banking just before we close.
From a credit union point of view, I think it's a bit, you could be reinventing the wheel a bit. I think if you supported the credit union movement you've already got, because there's no part of London that's not serviced by a credit union. And the danger is, unless the community bank is going to provide all of the services, you know, that the people need, it might not be the solution. You know, it could be part of the problem in a way.
Okay, that's...
We're seeing some credit unions kind of dual brand as a community bank, and I think that's an interesting approach. I was just up with one of the credit unions that's doing that. So in Derby, they're Erewash Credit Union / Derbyshire Community Bank. And when I asked them why, they said because many people don't like the word credit, they don't like the word union, and that is just enough to keep them at bay. Whereas if they change it to community bank, those are words they understand, and put together they're a positive alternative to a bank that they don't like the sound of. So I think there is something there about thinking about how it's branded, who you're working with. And again, I think, you know, community banking I think it's a positive thing if it's done well with robust information and understanding behind it. Often we see people start to kind of almost flirt with the idea of community banking because they don't really understand all of the issues that people are facing. And I think that's what, you know, Joan is counselling, which is good research, good thorough research. What are the unmet needs and what's the best way to meet these needs? And sometimes the answer will be a community bank. Often it won't be.
Yeah, I'd agree with that. Yeah, it's sort of what is the aim of the community bank? Is it to increase access to affordable credit? Is it to increase savings among kind of financially excluded people? And yeah, is it the best way to do it? I think I'd maybe come back to that Sheffield Money example as well. If one of the issues that you're seeing with credit unions is getting people in the door and raising awareness, but people might be put off by the brand, or having a kind of London-wide brand or some kind of platform that would encourage people to, even if they would be sort of signposted onto those, they're sort of directed onto those services directly, then it's that might be a way, and calling it a community bank or something. Yeah, I think if there's a need for that on top of what is already
What's already
available, then that would be useful. But if its aim is to fill some needs that are kind of already out there struggling, and I think particularly responsible finance providers, the sort of used to be called CDFIs, that they're particularly lending to the most higher risk, often the higher risk ones. I know there's one in East London, Fair Finance, and I'm not sure if there's another one in London, but yeah, I think some of those sort of community-based services are kind of thriving, but struggling to expand, or helping those alternatives to high-cost credit expand is a bit of a challenge, I think. So
I would just support all of that really, and just say, what problem is the community bank trying to solve that couldn't be solved already with the things that you've got on the ground? The other thing I would say is, it comes back to the points we were talking about earlier. You need to start from where people are who don't have these products and services, because we've done research, you know, in Bristol and elsewhere, where you talk to people who were kind of on the margins of banking services, and we had, you know, presentations from Barclays, we had presentations from the credit union, and when you talk to people about, you know, what they thought about these different services and providers, they said, well, you know, the credit union's really, really great, but actually I want to be like everybody else, so actually if I could, I'd take out an account with Barclays. And I've interviewed people who said, you know, what I really would put somebody in debt who said, you know, I can't access many products and services, but what I'd really like is a credit card, because then I'd be like everybody else.
We've had exactly that phrase.
And it's something about the trust, and there's, well, you know, we might all think that the big banks are terrible, and, you know, we don't really like them, we all use them, and there is something in the brand of them. You know, they are things that everybody else uses, they are trusted, and, you know, we need to understand the psychology between, you know, behind why people want to do some things and not others. It's not saying that community banks wouldn't appeal to a different demographic, but it might not solve the problem that you think is there.
Yeah, so it's public purpose. In the end, it's what are the problems that are out there, and is anything being done to actually address those actual issues where people are starting from?
Yeah, well, I think it comes back to Sian's point about don't make assumptions about what people want.
Yeah.
Because they need to tell you what they want, and it might not be what you think.
Yeah.
I think ultimately a lot of this is actually psychological, and how you see yourself in your whole life. Everybody else has a you know, mainstream bank account because it's normal, it's ordinary, and it's kind of ordinary people want. And actually it brings me back to a point that was made much earlier on about the cap on credit unions. I bet you if you could get that cap removed, the middle classes who don't feel left out of the banking system would rush to credit unions. It wouldn't be a problem for them. They'd quite happily put their money in help because they have all the other ordinary things going on, so they have nothing to prove to themselves about it. And I actually think, imagine I ran the universe, we'd be removing that tomorrow morning.
Imagine you ran the universe, Sean. That's a thought. I am going to bring us to a close. I would really like to thank every single one of you for all your contributions. It has been an incredibly informative and engaging afternoon. So just thank you so much for your time and for coming to share your ideas and knowledge with us. Can I finally ask the committee to note the report and the discussion with invited guests?
Noted.
Thank you very much. And can I also ask the committee to note the work programme for 2017-18 as set out in 4.2 to 4.8 of the report? Excellent. And to note the summary notes of the round table discussion on London's nighttime economy, which was held on the 5th of July 2017 and attached at Appendix 1 of the report.
Noted. And
to agree to delegate authority to me as chair in consultation with party group leads to agree arrangements for the future site visit to Hull, the UK's City of Culture.
Agreed.
And please can the committee note the next meeting will be taking place on Tuesday the 10th of October at 3:30 in Committee Room 5 in City Hall.
Noted.
And there is no urgent business, and so that concludes the meeting.
GLA Chamber Sound.